Good morning, everybody. This is Dan Smith with Tradition here. I hope that everybody is doing well. Hopefully, everybody can see my screen here. I got a bunch of stuff I'm going to run through today. I feel like it's been a while since I've done a little kind of update like this, so maybe it was early July, could have even been June. So, got a bunch of stuff I'm going to cover here. So, again, before we get rocking here, I want to take a moment here, thank everybody for your business, for choosing to work with Tradition. We greatly appreciate it and do not take it for granted. So, thank you all again. I'm going to go ahead and dive right in since I got a little more stuff than usual that I wanted to cover here. So first off here, kind of a quick, kind of real estate market prediction and update. Some stuff that I found interesting that I've seen the last couple of weeks here. So I'm not going to obviously run through every number on this grid right here, but I came across this yesterday, kind of a combination of what's happened so far year to date here in 2025 on a bunch of key economic indicators and information that really kind of real estate that impact real estate and housing finance here. So obviously everything here in gray is looking the rest of Q3 2025 and then into the future, the rest of this year and into 2026. As we all know, a lot of predictions are oftentimes very relatively inaccurate or very inaccurate. So it will be interesting to see how much of this as we move forward here ends up being accurate. What I found the most interesting looking at all of this is just how, I think just how consistent and how relatively flat a lot of it is. Looking at the 30-year fixed rate, obviously we're seeing a slow, projected decline over the rest of this year and into 2026. Some of this was released prior to, the movement that we've seen in the last week or so with some downward trend. So that, third quarter 2025, 6.7, call it 6.75. We've already kind of achieved that. Obviously it's dependent on loan type and scenario. But some of this stuff we've already seen happen. But looking at the last two rows there, what I find very interesting is that 10-year treasury, they're projecting to essentially be flat or even up over the next 6 quarters, including the rest of Q3 2025 here, with the 30-year fix, going down by 0.75%, give or take. So you're seeing that spread, they're projecting for that spread between the 10-year and the 30-year fixed rate to continue to shrink, which would be a really, really nice improvement, getting back to, kind of long-term historical norms between the 10-year and the 30-year fixed rate. But very, very flat, projecting out for the rest of this year and into next year. Which, across the board shows continued strength in the economy, with, maybe some potential weakness in certain areas here and there, leading to hopefully continuing to drive down our 30-year fixed rate, which obviously corresponds to everything else there. So next up here, grid I saw the other day here, or I should say a graphic, showing inventory across the country pre-COVID versus today. So basically 2019 to today. And I think everybody, if you kind of see looking at information and news on real estate across the country, really the big change that you see is certain areas have seen rapid growth in inventory, while other areas, most notably the Northeast, which doesn't impact any of us, but the upper Midwest here is seeing the exact opposite. Still, the amount of inventory dramatically lower than it was pre-COVID. So this was from early August, here in Minnesota, 34% below inventory today versus pre-COVID. Wisconsin, even worse than that, 46% below. Basically, everything in the Midwest is still far below where it was pre-COVID. You get down south, Arizona, obviously, I think people are aware of that, drastically higher, Texas, much higher, and then Florida as well, drastically higher. So here in the metro, upper Midwest, Minnesota, Wisconsin, still very, very tight on the inventory front. And I think it's going to continue to take time before you see a drastic change in that. But time will tell there. And then lastly here, kind of the nationwide forecast for what they are projecting for home sales, for existing, new, and then median home price mortgage rate. We kind of covered that before. And then this was released prior to the 8/1 jobs report, which had the massive revisions for the last 3 months, and then a big miss on that, which kind of changed a lot of things with the predictions here. But essentially, what you're looking at is, a lot of the stuff for 2025 for predictions are not going to hit as far as home sales, price growth, but they're predicting something better for 2026. So with all of this, obviously time will tell, but relatively flat across the board that we're seeing. I would, hopefully that number for existing home sales growing by 14% year over year. Hopefully that is the case. But if rates move where we want them to, that will unlock more of the market, and hopefully we can hit that number moving forward from there. So just a couple of things I'd seen lately on the kind of economic front that I wanted to share. I'm guessing most people have been following that and have seen some of that information at least. So next up here, I want to share an exciting update for our down payment assistance program here that we offer. So just kind of go back and start with what TCA, which is Tradition Community Assistance, is, and a little bit of an expansion that we have. So Tradition Community Assistance, TCA as we call it, is an entity that we started about 3 years ago. That took some time to get it the 501c3 IRS recognition for a nonprofit. And our entity serves to provide down payment and closing cost assistance for low to moderate income home buyers. So prior to this update and expansion of the program, it was limited to the 7-county Twin Cities metro area. We're now excited to offer what's essentially going to be a portfolio product in which TCA, our 501c3, is going to service these down payment assistance loans. So we're self-funding them with donations that we are getting from the community, from different organizations. So it is different than what we're calling the original product of TCA Core, being that it's going to be serviced in portfolio and from donations that we are getting. It's a drastically smaller loan amount, so it's kind of more of like a true closing cost second mortgage that people are able to access. But the thing with TCA, with the entity, is that since it is a 501c3, you are able to go above the normal 95% or 97% caps on the loan to value with that piggyback second mortgage from TCA. So this new product that we are offering, the big thing with it is that it is expanded out to all states in Minnesota here. So in the metro and outstate as well, out of the 7-county metro. It's going to be $5,000. Interest rate on it is 4.99%, so still below market. It's over 15-year fixed rate, and it is for first-time home buyers only. So all borrowers have to be first-time home buyers. The income on it is great because it expanded up from your usual 80% of AMI, which is home ready, home possible, in which we're going to go up to 100% of the area median income is the qualifying income for that. It's consistent with our original TCA product. Minimum FICO is 660. Mortgage insurance is going to be standard there. Oop, I got mortgage insurance on there twice here. So excited to go ahead and get this rolling here. So if you have borrowers that would qualify at 100% of the area median income, they are eligible and they are first-time home buyers, they can get $5,000, over 15 years that they can use to pay all of their closing costs probably, and even maybe a little bit of their down payment. Obviously, exactly what that would cover will depend on the unique loan scenario, as far as the purchase price there. So excited to launch that out across the entire state of Minnesota. And we're working on some other things as well, to hopefully have some additional products in other geographic areas here, as we move forward here in 2025 into 2026. So we're going to keep looking for more products like that to help more people. Next up here, something that we launched about a month ago, give or take, was something that we are calling Tradition Home Advantage, keeping with lots and lots of acronyms in the mortgage industry. So we got TCA, this is called THA. I'm not sure, at some point we're going to have to find something different here because there's too many of them that I'm starting to confuse myself here. So we wrote this and created this as our proprietary, if you will, first-time homebuyer education program. So if you have an application in which all borrowers are first-time homebuyers, looks like I spelled first wrong there. Apologize for that. So this is a course that we created. It's on our website. If you have borrowers that are first-time homebuyers, you can direct them there. I think it's really, really well done. It's kind of done in 3 different sections here. I have the agenda laid out here. So we have information on preparing for home ownership. Then we have the actual process of buying your home and getting financing for it. And then, once somebody has purchased that first home, what do they need to know? Some of this stuff, when I was writing it and putting it together, was a lot of the stuff that, 15 plus years ago when I bought my first house, it's like, what do I wish I would have known better? That, in 35 to 45 minutes, that I can get just enough information without taking a ton of time to be better educated as I start and go through that home buying process. And then once I was a home buyer, what do I really, really wish I would have known? So borrowers would go to the link, create a username and password, and it takes them through it step by step, section by section, learning about credit, when they're getting their pre-approval, appraisals, inspections, and then what to know about ongoing costs and maintenance once they are a home buyer. So it's interactive, they're not just, reading for 45 minutes. There's videos as well. It's a combination of click, things move, reading, and some animation videos. So something that you can definitely offer to your borrowers. Obviously, they'll be going out to our website, so we'll kind of explain the relationship between you and Tradition Mortgage if you don't do that up front as well. They complete that, they're going to get a certificate. Make sure they print that so you can give that to us. And with that, we're going to give them a $300 credit at closing. So something there, I think there's, good in several areas of it there. They're getting education, and then we have a credit that we can give back to them at closing to help them pay some of their closing costs. Next up here, going to talk a little bit about USDA. Going to talk about the USDA loan program. So if you're not, super familiar with USDA, I think, sometimes it can be a little bit, kind of overwhelming to kind of wrap your arms around and understand exactly what USDA is, because it's like, well, it's in rural areas. Is it only in rural areas, or there's certain towns that might be eligible for USDA? How does the income work? What's the fee that the borrower pays? There's a lot of moving parts to it. So if you haven't done USDA, I got 5 or 6 bullet points here that I think is enough to be dangerous, and maybe feel a little bit more confident, talking with clients, potential clients, about USDA, because if you're in an area where USDA is eligible, borrowers that don't have a ton of money for a down payment, really a great option to look at here. So USDA, from a high level, is a product that is designed for low to moderate income buyers in rural markets or in other in other areas that would qualify. So it's not always out in the country, in rural areas. There are some cities that would be eligible for this as well. So there are restrictions on the property location, but then maximum income as well. So usually with products, we look at, do they have enough income to qualify? This falls under that category of, there are income restrictions to it as well. I have a link here that will take you out to not only search if a property location is eligible, but then we'll have information on the maximum income that is eligible with it. So one of the big things with USDA, it's kind of similar to FHA and VA in some ways here. USDA has an upfront fee and a fee that is annualized, but it is paid monthly. So it's not mortgage insurance, but it is a monthly fee. So there is a 1% loan amount upfront fee that can be rolled in. So think about FHA, upfront mortgage insurance. So this is just a flat 1% and it's rolled into the loan amount, or they can pay it up front. So usually borrowers, it's 100% financing. So it's going to go to 101 loan to value will be your maximum loan to value if they're going to roll in that 1% fee. So low to moderate income buyers in rural areas, income restriction, property restrictions, 1% fee with that monthly fee that is paid annual fee that is paid monthly. So one of the other differences with USDA is that USDA is really sensitive about not only the back ratio, so the total ratio, which all loan types are, but USDA is sensitive about that front ratio as well, so the housing ratio. So USDA usually allows a maximum front ratio of 34% and then a back ratio of 41. But if you have somebody that has minimal debt, where that back ratio is still going to be eligible, but that front ratio is maybe a little bit high, if they have reserves as a compensating factor, sometimes those will be eligible. But you got to look extra close at USDA because you got to be sensitive to that front ratio and that back ratio. Both of those will matter. And since USDA is an income-driven restricted program, all income sources from all occupants have to be documented. So if you think about down payment assistance products, this kind of is similar to that because we're not only looking at the borrower income, we're looking at the household income. So there's more restrictive property requirements similar to FHA, more stringent than what you would see for Fannie or Freddie. And then there's kind of a two-step underwrite with USDA loans. So like with any loan, USDA loans are reviewed, underwritten, evaluated by the lender, and issued a clear to close. After that, loan applications have to go to USDA, and USDA reviews them, double checks everything, makes sure that the lender got everything correct, and then they issue what's called a conditional commitment. Loans cannot close until that conditional commitment has been issued by USDA. So timing is super, super important on USDA loans. If you have a 30-day close, it's important that everything gets moving basically day one right there, even 45-day turn times. You got to make sure that you are really, really on top of these and things are moving along there. So 5 or 6 bullet points there on USDA, some key things to remember. I would recommend saving this link right here for the property lookup and the income restrictions there. And remember that income that we're looking at there is maximum income to be eligible. It's not qualifying income. It is household income from all occupants of the property, not just borrowers there. So a little bit of a different kind of take on income there than what you would see with other loans. All right, last couple things here. All right, next up here, I just wanted to throw a couple of bullet points in here as far as non-QM, alt prime as I call it, alternative lending programs, expanded doc options. This continues to become, a larger and larger percentage of the business, not only that we are seeing, but that's happening out there in the industry in general. So, non-QM is the normal kind of name for it. It's not totally accurate because sometimes loans that fall into this technically are QM qualified mortgage loans. I kind of look at them more as, kind of expanded doc options, alternative lending programs. These are loans that I got some generalized product guidelines here. sometimes people still think of these here non-QM and they're like, well, this sounds like non-QM from way, 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 way back in the day. And it is not that at all. So in general, everything for these 4 bullet points that I have for the generalized types of loans that fall under here, you're going to have a max LTV of 80%. So they got to have that documented 20% plus skin in the game down payment, established credit, FICO score 660, 680 and above. DTI is a little bit flexible on this one. 50% is typically what we see for the maximum. And then there's reserves required on basically all of these loan products here. So you're seeing borrowers with a documented down payment, established credit score. You're not getting anything too exotic with these. Oftentimes, it is just an alternative way to show that a borrower has the ability to repay that loan. So if I break these up into kind of 4 main loan types, you have asset utilization. So again, asset utilization is a borrower that has a relatively significant amount of savings, whether it's in retirement, it's in non-retirement brokerage, stock bond, mutual fund accounts, could be checking and savings as well, but they have significant assets that we're able to say, okay, we're going to take these total assets and divide them by 84 months. Reduce them a little bit depending upon what the asset type is. So if it's retirement, you might take 80% of the balance and divide it by 84 months. That's the income that they get to qualify. You got a borrower that's got $50,000 in an IRA or a 401k, that's not going to get you too far. But if you have that borrower that's got, 750,000 to $1 million, that can be assets that can be used to qualify entirely or supplement other income that they might have, that can add to Social Security. If they just work part-time, you can combine those incomes and get a little bit more flexible with it. Next up would be bank statement income. So this is for self-employed borrowers. Maybe it's somebody that owns multiple businesses, or let's just say they have a good accountant where the business has really good cash flow, but they're able to, on their tax returns, show a lot of expenses to offset that income, and it's not showing a ton of taxable income. So what you do with bank statement loans is you get personal or business bank statements, and you're looking at the deposits going in there, and then there's an expense ratio. So if you got a borrower that that has $10,000 a month in deposits into their LLC business bank account, usually it's going to be a 50% expense ratio. So that 10,000 becomes 5,000 a month. So it's a good, way to alternatively document that borrowers have cash flow that they can use to repay the debt. DSCR loans, it stands for debt service coverage ratio. So this is an investment property purchase when you are only looking at how does the potential rent from an investment property that somebody is purchasing, how does that compare to the PITI for that property? We're not worried about what they do for work. We're not worried about if they're self-employed, if their business cash flows. We're only worried about if that property they're purchasing is going to cash flow positive. So there's some other things that go with that as far as how that impacts the rate, but that's what we're looking at. The cash flow from an investment property they're going to buy or refinance relative to the PITI of it. If you have a borrower that has some derogatory credit, whether it be foreclosure, bankruptcy, short sale, there is some slightly shorter waiting periods there. Like, you say it's 7 years for a Fannie Freddie loan for conventional. With non-QM, you might be able to do like 4 years. At the same time, FHA has shorter waiting periods that kind of match up with that. So sometimes there's a better option there for them. So last thing here I'm going to hit on, a pretty common question that we get from borrowers once their servicing has been transferred. I had an 85% loan to value loan. I'm just kind of talking as if I'm a borrower here. I got a loan I closed with that 85% loan to value. I've paid the loan down below 80%. How do I get rid of my mortgage insurance? Or I got a property that I bought for 85% loan to value. I put 15% down. I've done some improvements to the property. I believe that it has increased in value. So the combination of those two, I think I have that 20% equity position. I want to get rid of my mortgage insurance. How do I do that? What are the restrictions? What can happen on that? So a couple of things here with canceling PMI. So on this one here, I'm talking about Fannie Freddie loans, so conventional conforming loans. The most important rule with canceling PMI is that the servicer investor of the loan always has the final say. So they need to talk to their servicer. They got to, explain the situation. The servicer will look at their loan amount relative to where it started, and they will help them through it. They will always have the final say on whether it can be removed or not. So there's something called HPA, the Homeowners Protection Act. This mandates the cancellation of PMI for one unit primary residences. Notably, this does not qualify for second homes or investment properties, although you're probably not going to have either of those that close with mortgage insurance. So the difference, there's kind of two different paths for borrowers that want to get their PMI canceled. So the first one is using the original property value. So if the home was a purchase, that's going to be the lesser of the purchase price or the appraised value, usually the purchase price, or the current property value. So that would be the second option I gave, talking about a combination of increase in value with paying the loan amount, with making improvements to it. So let's talk about the first one here because it's easier. So if you're going off of the original property value, so essentially the original amortization schedule for the home, then the Homeowners Protection Act applies. This is what the majority of these fall under here. So if we are looking to cancel PMI based on original property value, the servicer of loans is required by law to cancel when the loan to value reaches 78% based on the initial amortization schedule. So the borrower pays the loan down, it gets to 78%. It takes a month or two for their system to kind of process that, but law does require that it automatically drops off at 78%. What I often see is that borrowers know, okay, the rule when a loan is originated is 20% down to not have mortgage insurance. Well, HPA goes to 78% to give a little bit of a buffer there. Note, this can only be canceled under HPA if the borrower is current on the loan and has a satisfactory payment history. So, if a borrower has sporadic lates, whether it was just within the first 30 days, they just had a late fee. If they had 30-day late here and there, they're probably for sure not going to get that dropped. And then the servicer also has the right to require MI to continue on loans that they deem high risk. That can mean a lot of different things, but I think it's basically going to come down to the borrower's payment history on the loans. If borrowers pay on time, they reach that 78% threshold under HPA, it is going to automatically drop off under law. The borrowers can also under HPA request that servicer cancel MI when the loan is exactly at 80% based on the initial amortization schedule. It can only be canceled if, let's go to the next page here, a couple of things with it. There's no subordinate lien, they have a good payment history, and the borrower satisfies the servicer requirements that the property has not declined in value. Servicer might order a quick online appraisal. They might do a full appraisal. So there are some differences there between just getting to 80% and 78%. So 78% is kind of the magic number if you go off of the original amortization schedule. So if you just use simple numbers for this, somebody buys a house for $100,000. They put 5% down, so their loan amount was $95,000. They would need to pay it down to $78,000 to get to a point where they have that 22%, 78% loan to value to have that automatically drop off. If they just got it to 80% LTV, they need to take some steps with it there. So small difference between 80 and 78, but makes a big difference in the exact process to get it dropped off. Okay, the second option is if a borrower wants to cancel their PMI based on the current property value. So this is where we're not factoring in the original value of the property or the purchase price, the initial amortization schedule. So this is going to be like I said at the beginning, talking about this, if you have that borrower that usually it's a combination of, they redid the basement, they put a new roof on, they redid the kitchen, the bathrooms, they've done property improvements, and they believe that the market value has just kind of generally increased, the property itself and the neighborhood with it. So this is where that Homeowners Protection Act does not apply. So when I say the requirements here, these are typical requirements. Since this is not mandated by law exactly what is going to happen, investors and servicers of loans have a lot more leeway and a lot more flexibility with how this is handled. These are general requirements that every mortgage insurance company out there that I've talked with has said, yep, this is what we typically see. There's not a lot of variation, but there is variation investor, servicer by servicer here. So first off, the loan has to be seasoned at least 2 years. So that's kind of, the minimum. With the first option that I talked about, there is no minimum. With this option here, there is a 2-year typical seasoning. Um, if the borrowers have made substantial improvements, this can potentially be waived, but that's usually the initial, kind of first trigger to it is seasoned 2 years. That servicer of the loan is definitely going to want to get an appraisal or some other valuation product to see exactly what that property is worth. I think that's pretty straightforward because we're saying, hey, property's increased in value. I made all sorts of improvements to it. Now I have 30% equity in it. Well, we got to go out and do an appraisal on it to make sure that is accurate. Like we've talked about all throughout this, borrowers have to have an acceptable payment history. And here's where we have another seasoning requirement in here. And this is where I see the biggest thing that leads to confusion out there. So just a second ago, I said bare minimum, borrowers have to be seasoned at least 2 years. But now there's another seasoning in here, and this triggers to an LTV as well. So the LTV based on a current appraisal has to be 75% or lower if less than 5 years have elapsed. So let's just say they have to have two. So between 2 years and 5 years, okay, now we're going from 80% LTV to 75%. So it's another 5% that most servicers will want to see here. Or if the LTV is 80% or lower, the loan has to be seasoned at least 5 years. So if it's less than 5 years, they want to see that tip of that extra 5% equity. If it's if it's more than 5 years, they will usually go right to that 20% equity here. So a lot of moving pieces there. We do have a piece that I put together that kind of covers all of this that we could certainly share with you if you ever have a borrower that reaches out with questions on this, because there's a lot of moving pieces here. But you kind of got column A if you're basing it off of that initial amortization schedule, and you got section B where they're not worrying about that initial amortization. It's all about the current property value there. And then it's kind of much more open-ended, more confusing, if you will. There are more things that you have to remember there. So with that, that was everything that I had today. Certainly the longest call that I've ever done on these here. So I appreciate everybody sticking with me here. Does anybody have any questions at all for me? If you can unmute yourself, you're welcome to throw them my way, or you could drop them in the chat. I'll hang out here for a few minutes. If anybody has any questions you want to bounce off me before we wrap it up here, I will monitor the chat here and listen for any questions. If not, you're more than welcome to follow up with me or your rep contact here at Tradition after the call as well. But if you got anything you want to throw my way, I am all ears for it. All right, I am not seeing anything, getting anything here. So with that, I'm going to go ahead and wrap it up here. Again, thank you everybody for your time here today, for sticking with me for 35 solid minutes here. Appreciate everybody's time here today and your business as always. I hope everybody has a great rest of your day here and, well, last week of summer here, I guess. So enjoy the rest of the summer here, and we will hope to talk to everybody soon. Thank y'all.